Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Christine Benz provides tips for approaching asset allocation when the stock market is volatile. Travis Miller shares 3 utility names in promising positions. And Kevin Brown highlights 2 companies that are paying above average dividends. Let's get started. Here are Susan Jabinski and Christine Benz of Morningstar, Inc.
Hi, I'm Susan Jabinski with Morningstar.com. The stock market has staged quite a comeback since hitting its market lows in March. Here with me today to talk about how investors should be thinking about their stock allocations is Christine Benz. Christine is Morningstar's Director of Personal Finance. Christine, thank you for joining us today.
Susan, it's great to be here.
Now, let's take a step back and talk a little bit about the surge we've seen in the stock market during the past several weeks. What do you think is behind that?
Well, a couple of key things. One is obviously that investors are looking forward and assuming that we at some point will emerge from the pandemic and that the economy will take off. So stocks have been bid up accordingly, in large part because of that overall sentiment. Another thing that is in play, and it has been in play for several years now, is what's been called the TINA hypothesis, the TINA hypothesis. And the idea is there is no alternative to stocks. And that's accentuated given how low we've seen yields go. In an effort to stoke the economy, the Federal Reserve has brought yields way down, and that leaves investors who want to earn a positive return on their money on an inflation-adjusted basis with few options besides stocks. So I would say those 2 factors have been central to stocks' ascent recently.
So let's talk a little bit about that effect in these very low yields we're seeing. Given where we are today, what can investors expect from their safer investments like bonds going forward?
Well, that's a problem because historically, starting yields have been a really good predictor of what you would expect bonds to return over the subsequent decades. So where we are today, where you're barely wringing out a positive return, that portends very meager returns for bond investors over the next decade. So investors need to be careful about overdoing safety, given that the return prospects for bonds, for cash, are so low over the next decade. That's not to say that you can extrapolate that into perpetuity. At some point, we may see yields pop back up, especially if the economy improves, but that may be accompanied by inflation. So investors, again, do need to be careful about overdoing the safe pieces of their portfolios.
So given those very low expectations for safer securities going forward, is that a vote then to go sort of all in on equities?
Well, I think it depends on your life stage. So for younger investors, I do think that they probably, to the extent that they don't have near-term expenditures, they probably would want to steer the bulk of their investment savings, their retirement savings certainly, into equity assets. Older investors, though, I think need to be more careful. They need to take some steps to kind of right-size their equity exposure. And the main idea for them is that if we do experience more volatility in the market, and I think that's realistic to assume, that they would want to have a portion of their portfolio that they could draw upon if they needed to, so that they weren't having to withdraw from depressed equity assets. So I think it really does depend on your life stage.
So if investors are sort of looking for a guidepost about, okay, given where I am at my life stage right now, what should my, stock bonds asset allocation look like? Where would you direct folks for some ideas on that?
Well, I think a financial advisor can certainly help you custom craft a sensible asset allocation. I think investors who are just starting out might reasonably look to target date funds. They might invest in target date funds or just use them as a benchmark for what's a reasonable stock bond mix given their life stage. If you look at target date funds for people who are just starting out in their careers, well into like their 40s, you see very heavy allocations to equities in the range of 90%, 80%, maybe for people in their 40s. So equities stay quite high. For people who are getting close to retirement, obviously the bond piece picks up a little bit, but it still remains high. I was recently looking at equity allocations for people retiring in the year 2030, actually giving some guidance to some friends, and what I saw were equity allocations in the range of 65 to 70%. So I think that's a good starting point. Once you get close to retirement, I like the idea of really custom crafting an asset allocation, using starting portfolio withdrawals to guide how much you allocate to cash, to bonds. If you are someone who's just embarking on retirement, I like the idea of having roughly 10 years worth of safe assets, some cash, mainly bonds, that you could draw upon if stocks encounter a downturn that's more sustained than the one that we've experienced recently.
But overall, it looks like despite the comeback in the market in stocks, it's still a place for especially those savers to be today.
Definitely. I think that savers need to look at all the levers they can pull, but one of the best ways that they can make sure that their portfolios are in line to meet their eventual retirement goals is to have an ample equity weighting.
Christine, thank you as always for the thoughtful insights today.
Thank you so much, Susan.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, Travis Miller of Morningstar Research Services shares 3 utility names in promising positions.
Utilities are often considered a place of safety for investors. That wasn't always the case in March and April as the markets took their turbulent run. The one thing that was a place of safety for utilities was the dividends, and especially the dividend yields for utilities right now. When you look at where bond yields are, and especially U.S. Treasury rates right now, with utilities dividend yields above 3% for the sector, that's a very attractive spread for income investors right now, investing in utilities. We think that the utilities in the U.S. are well positioned to affirm and even grow their dividends over the next few years. Names like Southern Company, Duke Energy, and Edison International all trade at yields above 4% and at or below our fair value estimates. For Edison International, with a yield over 4% right now, we think it has also great growth opportunities, being a utility in California, trying to invest in infrastructure to support the state's 100% renewable energy goal. For Duke and Southern Company, again, both yielding over 4%, we think they have growth opportunities in the Southeast as these large utilities invest in infrastructure to support some population growth, but also a lot of new renewable energy growth. We think utilities are a good place for income-seeking investors, both because of the attractive yield relative to other yield investments such as bonds and even U.S. Treasuries. And we also think there's still growth, and we see very strong balance sheets that are going to support the dividend and that growth over the next 3 to 5 years.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
And lastly, Kevin Brown from Morningstar Research Services highlights 2 companies that are paying above average dividends.
Real estate investment trusts are attractive investments for income-oriented investors, so we want to highlight 2 companies that are paying above average dividends. While there are many REITs that have high current yields, many of those high-yielding companies are delaying decisions on paying out second quarter dividends, potentially leaving investors with a much lower yield than they would have anticipated. The 2 companies that we want to highlight have already declared the second quarter dividends, and we believe their cash flows should remain steady enough to consistently pay their dividend levels. HealthPeak is a healthcare REIT currently providing a mid 5% dividend yield. The company's portfolio of life science buildings in some of the largest research campuses across the country and medical office buildings attached to major hospital systems should continue to provide HealthPeak with dependable, growing streams of revenue. While senior housing is going through a downturn due to the coronavirus, this segment should produce significant growth over the next decade as demand from the baby boomers picks up. We think Healthpeak presents a safe short-term investment with fundamentals that will trend upward over the coming years. Shopping center REIT Regency Center provides a solid 5% dividend yield at a significant discount to our fair value estimate. The company has traded off on fears of retail weakness stemming from coronavirus shutdowns and a broad economic recession impacting the company's portfolio. However, Regency's strategy to own high quality shopping centers with grocery stores as anchors is paying off, as grocery stores are one of the few retail industries seeing an uptick in sales over the past few months. This is keeping foot traffic high at Regency's portfolio, which supports sales and thus revenue for Regency. We therefore think Regency's dividend is relatively safe despite the chaos in the retail environment. In summary, there are several REITs that income-oriented investors should keep an eye on for both high dividend payouts and potential capital gains.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcasts@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.